Howdy, ladies and gentlemen. I'm Raymond Dahlman, your humble host here at the Liberty Call for Wednesday, February 16th, 2022. I hope everybody's having a great day out there. It's a little cloudy here on the Front Range. We're expecting 4 to 8 inches of snow. My guess would probably be somewhere between 6 and 10 inches. We usually get a little more snow here in our location than the forecast. So keep your fingers crossed. Make sure, or hoping that we don't lose power or anything like that. But other than that, we should be good. And we'll be kind of trapped here for about 24 hours, and then we'll dig our way out again. So like I said, hope everyone's having a great day. If it's your first time watching, please click on that subscribe button. It's probably down here somewhere. And share with friends and family. I'd greatly appreciate it. All right, let's go ahead and take a look and see how the markets did today. It's kind of a back and forth day in the markets. The Dow Jones was quite a ways down early this morning, and it rallied back. So let's go ahead and take a look. Dow Jones closed down 0.16% to 34,934. S&P 500 was up 0.09%, so basically flat at 4570 or 4475. NASDAQ closed down 0.11, also flat at 14,124. Small caps are flat also. The VIX was down again today, another 5.49%, closing at 2429. That's a good sign. And let's see, kind of a mixed market. It looks like over in Europe, in Germany, France, or that was Britain, France, and the Eurozone, they closed down at worst 0.28. And then we have a bunch here, Netherlands, Spain, Italy, Switzerland, down to, what is this? Austria. They're all in the positive. Some is close to 1% up. And see, the Eastern Europe, mostly green. And then almost all green across the Asian markets until you get down to India and Pakistan. So, but most of the major markets appear to have been up or flat for trading day, February 16th. So all in all, not too terrible. I think it's kind of the quiet before the storm. We have the Fed meeting coming up a month from now, and that at that point, the speculation is that it's going to be a 50 basis point or 0.5% rate increase for the Fed funds rate. And, all the, people the big shots are all, wringing their hands, worried that interest rates are going to go up too fast. And, I guess they're worried about losing all that access to cheap and free money that can be lent out. So I'm more of a sound money guy. I really don't like the fractional reserve banking system that we use, where you just create dollars out of thin air. I'd much prefer a sound money system where every dollar is backed by something. But again, no one ever asks me. All right, let's go ahead. I got to see here 4 articles I want to breeze through. Fed members back faster rate hikes, significant balance sheet reduction. This comes from minutes from last month's Fed meeting. This was written by Yassine Ibrahim from investing.com. Federal Reserve officials were in favor of reining in and accommodative monetary policy measures with a faster pace of rate increases and a significant reduction in the size of balance sheet that could begin later this year. The Fed's January meeting minutes showed on Wednesday. With inflation well above 2% and a strong labor market, members expected that it would soon be appropriate to raise the target rate for the federal funds rate. According to the minutes, the faster pace of rate hikes, however, is conditional on whether the pace of inflation continues to trend above target or eventually dissipates. Most participants noted that if inflation does not move down as they expected, it would be appropriate for the committee to remove policy accommodation for a faster pace than they currently anticipate. The odds of 50 basis point rate hikes at the Fed meeting has eased slightly to about 50%, 25% last week, according to investing.com's Fed rate monitor tool. On the balance sheet, Fed members noted that a significant reduction in the size of the balance sheet would be likely be appropriate, which could get underway sometime later this year. Following its previous January 25th and 26th meeting, the FOMC kept its benchmark rate at 0 to 0.25%, but teed up the prospect of increasing interest rates at its next meeting in March. In his press conference following the monetary policy statement, Fed Reserve Chairman Jerome Powell stoked fears of aggressive Fed rate hikes, saying there was quite a bit of room to raise rates without hurting jobs. Since the meeting in January, inflation has continued to trend well above the Fed's 2% target. The labor market is inching closer to maximum employment, and the once low prospect of 50 basis point rate hike is being priced in. The odds of a 50 basis point rate hike jumped to about 60% this week from 30% last week. The St. Louis Fed president, who tends to lean more hawkish on monetary policy, has been one of the more audible members among his peers, calling for aggressive Fed rate hikes. I'd like to see 100 basis points in the bag by July 1st, James Bullard said in an interview with Bloomberg. Yeah, we already talked about that. All right, so most of this stuff we've already talked about already. So again, the meeting minutes just confirmed what we've already really known, that we're probably going to expect 0.5% next month. I'd personally like to see it go higher, but Mr. Bullard from the St. Louis Fed would like to see up to 1% by summertime. I think that's certainly doable. I don't think it'll cause the world to come to a collapse, but we'll see. I mean, it's it's kind of a play it by ear and see what happens. All right, next article: U.S. import prices rebound sharply in January. This comes from Reuters. U.S. import prices increased by the most in nearly 11 years in January amid a jump the cost of energy products, jump in costs of energy products. Strained supply chains, the latest indication of high inflation, could persist for a while. Import prices increased 2% last month, the largest increase since April of 2011, after declining 0.4% in December. The Labor Department said on Wednesday, in the 12 months through January, prices accelerated 10.8% after rising 10.2% in January. Economists polled by Reuters had forecast import prices, which exclude tariffs, advancing by 1.3%. So they were about 0.7% off. The report followed news on Tuesday that producer prices increased the most in 8 months in January. Consumer prices also rose solidly last month, with the annual inflation rate posting its largest increase in 40 years. Supply bottlenecks had shown signs of easing towards the end of 2021, but that progress stalled as COVID-19 cases driven by the Omicron variant raged around the globe. I don't see what that had to do with anything. But hey, they can continue to go with that story. Imported fuel prices shot up 9.3% last month after decreasing 8.3% in December. Petroleum prices surged 9.5%, while the cost of imported food accelerated 3.6%. Excluding fuel and food, import prices rose 1.1%. The so-called core import prices gained 0.6% in December. They increased 6.2% on a year-on-year basis in January. So again, things are still getting more and more expensive, but we shall see. All right. Next article, a State Street strategist says markets have got carried away on interest rate hike expectations. All righty here. Des Lawrence, senior investment strategist at State Street Global Advisors, thinks the market may have gotten carried away with expectations for interest rate hikes from central banks in both the U.S. and the UK, while Fed fund futures suggest as many as 7 rate hikes this year. Lawrence says the Federal Reserve may end up just doing 2 or 3 increases. The economy is starting to roll over, Lawrence said. We've gone past the peak in economic output, and we've gone past the peak in both monetary and fiscal stimulus, he says. What's missing, he says, is the peak in inflation. But in the second half of the year, some elements driving prices higher will fall out of the comparisons. Roughly 2 percentage points of the 7.5% year-over-year climb in inflation is attributable to energy, unless we get multiple shocks that embed themselves in the next couple of quarters that by construction will roll out. So I think that's the difference between us and the market. Lawrence says the potential for the Fed and other central banks to overreact is a gray swan, but he expects a soft landing. People put a lot of credibility in and faith in the central banks, and you've seen from the Bank of England Governor Andrew Bailey, they don't always get their speeches perfect. They may make mistakes in interviews. They make mistakes as a collective group, and then they move back from them, he said. But we don't see that as something that's a base case that's causing economies to nosedive into a recession, he said. The U.S. consumer still has significant levels of savings, and across corporate America, debt levels are pretty good and have been termed out. He does think the current volatility of the VIX will continue owing to interest rate uncertainty. When you look at the equity markets, they're not cheap, he adds. he thought that single-digit percentage returns are possible as earnings will allow companies to grow into their valuations. The S&P 500 has dropped 6% this year. All right. So yeah, the rest of this just getting into a portfolio. So I mean, personally, am I worried about the market and with what's going to happen with interest rates and whether or not we go through some sort of a downward market cycle, which quite frankly we were due. The 1-2 years ago was what I was expecting to occur, and then with all the stimulus and free cash, really bailed out a lot of companies that probably were headed towards the exit. So the way I look at it is strong companies with strong balance sheets and strong inflows and outflows of money, they're going to be fine. Yeah, they'll have some bumps. Maybe their stock price will suffer in the short term, but as long as they're making more money than they're spending, those are the companies to invest in. I mean, it's not rocket science. Now, are you going to get the huge returns of growth stocks where all they're doing is pouring money back into their investments or into their company? Higher interest rates are going to put a bit of a damper on that, but sometimes you have to go with your tried and true companies to get you through some bad times. So again, I'm not too worried about it. All right, one last article here. 2 big hurdles keep many Americans from saving for retirement, by Carrie Hannon. This was published today, February 16th. For many Americans, saving for retirement is a luxury. More than 1/3 of Americans say they have never had a retirement account, such as a 401k or an IRA, according to a Bankrate survey. A Harris Poll survey released in December reported more than a fifth of the more than 2,000 adults canvassed are saving nothing each year for retirement. Those are 2 big reasons for the lack of savings, and one of them is not easily solvable. Many workers do not have employer-provided retirement accounts, while others simply don't have anything to save. Access to retirement plans is an important driver. Roughly half of American workers don't have that, said Craig Copeland, EBRI Senior Research Associate. Many workers are low-wage workers throughout their careers and really don't have enough money to save in a retirement plan. They are trying to pay off debts just to make ends meet. Traditional employer-based retirement plans are typically not available for contractors, freelancers, gig economy workers, and part-time workers. And only 42% of small businesses with less than 100 employees offer retirement benefits, according to a LIMRA 2019 study. Why small businesses don't offer retirement plans to their employees is pretty straightforward, said David Deeds of the Schultz Professor of Entrepreneurship at the University of St. Thomas in Minneapolis. They didn't need to in order to hire and retain employees in the previous labor market, weren't required by state or federal governments, and the perceived costs and complexity, real or imagined, of managing retirement benefits keeps at least half of small businesses from offering retirement benefits. Even without a workplace retirement plan, those who earn income can still contribute to an IRA, says Greg McBride, Chief Financial Analyst at Bankrate. You can open an IRA with a brokerage, mutual fund company, or bank, or credit union in many cases. Have automatic monthly transfers from your checking account into your IRA to automate retirement savings. A handful of states, Oregon, California, and Illinois, now offer auto IRA state-sponsored retirement plans to workers without employer-sponsored plans. Other states are considering crafting similar offerings. These state-facilitated programs automatically enroll workers in moderate-risk, low-cost retirement savings accounts called auto IRAs. 3/4 of Americans say they would participate in state-sponsored retirement program if offered one in their state, according to a survey. State-sponsored retirement savings plans are the best chance in the near term to increase the number of Americans with access to payroll deduction retirement savings plans, wrote David John, Deputy Director of Retirement Savings Project at the Brookings Institute. All right, nothing to spare. So the other reason that brings us to the second reason for not saving for retirement, lack of funds, is the other indisputable roadblock. More than 1/3 of those who do not contribute to retirement plans say it's because they can't afford to do so, according to a Magnify survey of more than 1,200 working Americans. And nearly 50% of those with annual incomes less than $50,000 said they never had a retirement account, according to Bankrate. Choosing between staying afloat and setting aside some short-term savings and student debt payments often prevents Gen Z and younger workers from contributing to retirement, said Lazada Rainey Braxton. Always love when people have 3 names. A financial planner and co-CEO of 2050 Wealth Partners in Brooklyn. So I'm gonna go ahead and stop that there. Now, I do feel for those who work for small businesses. I have a small business here. And I wouldn't say it's the complexity of a retirement plan. I mean, they're not very hard to set up. Most or pretty much every wirehouse or investment firm, whether or not it's TD Ameritrade or Charles Schwab or any of them out there, all the online brokerages, you can set up an IRA in a matter of minutes. I know I do it all the time. And it's so yeah, I can understand you go to work somewhere, like a big company, back in 20 years ago when I was working for Citigroup, it was very easy. You just back then you didn't even do it online. You had to fill out paperwork to do it. But in today's world, you can go onto your like little HR portal and set up how much you want to have diverted to a 401k account, how you want it invested, especially if you're getting a match, hey, it's free money. But you could easily do this on your own. So the fact that your company doesn't provide something or your state doesn't mandate it or force companies to provide retirement accounts, I mean, come on, have some ownership over your own savings. So, to me, that's a weak excuse. Now, for those who just don't have enough money to go around, maybe you're in a low income job. See, that's a you problem at that point. You're only worth what your employer is willing to pay you, and it's a supply demand situation. So if your skills are not highly in demand, you're going to get a low wage for that. So what I would suggest doing is maybe going on to like monster.com or any of the job sites that are out there. Find a career that that you would be interested in doing and that pays well, and then get the skills to gain or to work in said career. That's my best advice for folks. It's not a matter of, oh, well, they need to pay me $20 an hour to flip burgers at McDonald's, which they are doing. It's insane. I see that the ads out when I'm out and about of what they're paying people to, stock groceries and stuff. I mean, it's insane. So, I mean, I don't know. So I guess for the most folks who've never actually run a P&L or run a business, you have to do a cost benefit analysis. I mean, that's something that I do anytime I'm looking to hire a vendor or use some new software. I have to evaluate whether or not the cost is, if I'm going to get my money back out of it or if I'm going to break even. And, that's how, most people determine whether or not they're going to bring on staff or, a new technology or do a build out. You have to evaluate whether or not you're going to, make money off of that process. And if you're paying people more than you're going to make, it doesn't make sense to hire those folks. So anyways, all right. Well, that's everything I had for today. I hope everyone has a fantastic Wednesday evening. It is hump day. So everyone go out and have some fun while I'm trapped here. The snow should probably be starting in about 15 or 20 minutes if it sticks to forecast. So, anyways, all right. Well, hope everyone has a great night, and I'll see you tomorrow for the Liberty Call for Thursday. And have a good evening. Bye-bye.